Our investment philosophy centers around asset allocation. We believe that active asset allocation is the primary determinant to your returns. That means understanding what environment we are under and adjusting the asset allocation of your portfolio to be growth-seeking or defensive for our clients. We believe it's very important to understand diversification. We know in an environment with rising interest rates and rising inflation, a simple equity bond portfolio isn't good enough to diversify clients. It's too simple. It's simple diversification. We want to think about smarter diversification because we know the relationships between assets change. The behavior of assets change. So we want to diversify the portfolio in different ways and at different times. This allows us to prevent portfolios from experiencing really deep drawdowns. Those disastrous years we want to avoid. We want to protect clients during these periods of time. And that is about looking for smarter diversification. Finally, we believe in clear and transparent implementation. We believe this builds trust with our clients. It means that we can look at and understand all the risks in the portfolio so we can effectively manage those risks on our clients' behalf. That's what we believe true active asset allocation is about, and that is what the Dynamic Allocation Fund will do. As we know, we've recently experienced a very sharp correction in equity markets. For us, in the Dynamic Allocation Fund, we want to examine the way that we manage through that period and indeed help to protect clients through that stressful time. What we saw in November was a very sharp drop in the price of volatility, which meant that we were able to take advantage of this scenario to build optionality around the portfolio to protect the clients. We saw a sharp rise in both equity prices and bond yields. This was, in our view, going to cause some disruption. Our work on sentiment, which shows how investors are feeling, the behavior of investors in January became quite dangerous on our models. This meant that we were going to enter a period of higher volatility. We took evasive action to downgrade equities in January, which meant we were able to adjust the portfolio and protect the capital of clients through the very sharp drop in equity markets. When changing asset allocation, it's very important for us to change that asset allocation meaningfully and significantly when it's most appropriate. In certain instances, for example, the middle of the year in 2015, we got quite worried about the growth rate of the Chinese economy. We felt that there was going to be a negative surprise in that growth rate, and that would affect equity prices around the globe. We felt in turn, if the Chinese were to devalue their currency, that would cause mass panic. We decided to move our equity allocation from 55% down to 18% to protect our clients during that time. 55 to 18 shows the extent that we will go to really diversify the portfolio and protect clients. We did a similar event during the Brexit episode, where we reduced our equity allocation to 20%, removing European equities from the portfolio. We did this so that we could really protect the client because we did not know the result of a binary election. Therefore, we do not take undue risk. However, in the aftermath, we moved equities from 20% to 40%, really taking advantage of the opportunity there. It's important to know that we will move the portfolio for you in a decisive manner to protect you and to take opportunity, defend and create growth. That is what the Dynamic Allocation Fund will do. Today we believe inflation is rising, as are interest rates. The global economy is improving, but with higher interest rates and higher inflation, we need to think much more clearly about where to allocate our funds. We know that in such an environment, we want to be positively exposed to cyclical areas of the economy and avoid leveraged areas of the economy. Today, we feel leveraged areas of the economy are those in the safe defensive sectors, whereas we much prefer the cyclical areas of financials, of technology, and of materials. We think this is going to be a better place for us to invest the money over this period, especially financials, which benefit from a better economy, higher interest rates, and will help build on good growth in 2017.